does the market have a handle right now on how to price assets? Chris Watling, the CEO and Chief Market Strategist of Longview Economics, joins us now. Chris, the world is a volatile place. There's a number of factors, there's a number of reasons behind that. Do you think markets have got a good grip on what is happening here, a good enough grip to make a call on where you want to put money to work?
I think markets are getting a grip on it. I mean, the uncertainty was high at its highest probably a number of weeks ago. Ideally, I suspect, yeah, when the invasion actually happened was probably at its peak uncertainty. The market's getting a grip, I think, on how this conflict may well play out. That's not to say they know for sure, but the uncertainty levels, while still high, are less high than they were. And of course, markets have moved lower over the course of recent weeks to discount that uncertainty. And there's a lot of fear being built up, a lot of hedging being put in portfolios. So, yeah, I think markets are getting their head around it. It's what started off as a normal sell-off, and tech stocks in particular were leading the market lower, evolved into a third wave of selling, if you like, more recently, and on the back of this conflict. And yeah, I think a lot of it's probably priced in by now. And this is, I would suspect, a significant buying opportunity for the majority of this year, if not the entirety of this year.
What's the biggest downside risk to that, though, Chris?
Well, I mean, there's always downside risks, of course, and bull markets climb a wall of worry. But I think the biggest risk is probably people have miscalculated, and Putin actually has far worse intentions than we realize. I think the market's got its head around that at the moment, but maybe the market's got that wrong, and maybe Putin doesn't just want to bite off half or whole of Ukraine, and maybe there's a bigger agenda out there that becomes more troubling, or maybe there's an accident in conflict that sparks something that one doesn't expect. So that's a big risk. That, you know, people are worried about the idea that the Fed may become more hawkish. That's something to focus on. People are worried, I think, that maybe there's some ripple effects from Russia being excluded from the global economy, much like we saw in 1998 when Russia caused a major financial crisis. So there is always a ton of things to worry about, but that's what markets do. They're good at that, and they discount them, and they're discounting machines.
How worried are you about a recession, Chris?
It's not my central case. There is too much cash on the sidelines in terms of in people's bank accounts, in corporate bank accounts, household bank accounts. Yes, we've had a bit of an oil price spike, and we've got a gas price spike. These are issues. But, you know, if you listen to what the CEOs of American banks are saying, and I think it's similar in the UK and to a degree in the Eurozone, people of all income levels have got much more cash in their bank than they had pre-pandemic. So there's a cushion, and actually, you know, as we've seen, the oil price has faded in the last few months. So I would say recession risk it's always there, but I put it at 10-15%. It's certainly not a central case here.
Do you think the Fed would be okay with causing a recession if it got inflation under control?
Well, that's certainly one's view. That's the market's view, that the Fed's caused every recession in order to control inflation, pretty much. So, yeah, I mean, if they become resolute and get the bit between their teeth in terms of rate hikes to control this inflation, and if they struggle to do that, then I think they'd be perfectly happy causing recession in order to achieve that inflation goal. But I don't think they're at that stage at the moment. We're going to have our first hike tonight, probably, and it's the first of many. We're a long way away from money being tight, I think, and we're a long way away from liquidity being too tight and being tight enough to cause that recession. But yes, I think they'll have the resolution to do it if they need to do it, and we'll find out probably later this year or as we get into 2023.
So the possibility is there that we will see significantly tighter monetary conditions going into next year. Do you think the market has adjusted to that, Chris? Equities have come down fairly sharply. Do you think that the market has now priced, all asset prices are now aligned with the idea that we are going to see 5, 6, 7, maybe more rate hikes from the Fed this year?
I think they're aligned with that sort of scenario that you paint, that we've got 4, 5, 6, 7 this year. I don't think they're aligned with the idea that we need a lot more than that over this cycle. And this is why this Fed meeting tonight is going to be utterly fascinating, because if you look at the medium term, long term Fed terminal rates that the dot plots talk about, they're at 2.5%, which is really not much more than where we're likely to be by the end of this year. If you look at 4-5-year Fed funds, 2024, 2025, that sort of area, they're hardly above where Fed funds is at the end of this year. So the market's priced a lot of hikes in the first year, 18 months, not much beyond that. That's what's really interesting. And that will speak to how persistent inflation is or is not, to how much the Fed will need to hike beyond the next 12, 18 months. And that's when it gets interesting. So we're definitely priced in for the first 4, 5, 6. That's fine. That's not an issue. What's interesting is as you get to the back end of this year, do we need actually to start pricing another 4, 5, or 6? That's when financial conditions might be troubling, might start to tighten up. But for now, yeah, we're priced. It's in the bag. We've had what I call phase 2 of a stylized cyclical bull market. We've digested those first few rate hikes. And normally the market starts to rally when they actually do the first hike rather than just thinking about doing it, so to speak. So tonight could be interesting.
It could indeed. Just under 3 hours to go until that decision. A little bit later, the press conference. Thank you so much to Chris Watling of Longview Economics. We appreciate it.